Welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management. I'm joined today by our Global Head of Macro, Tactical Asset Allocation and Alpha, Haydn Davies. Good afternoon, Haydn.
Good afternoon.
Okay, so let's kick off straight away. UK inflation is now below 10% for the first time since last August, but isn't falling as quickly as people expected. What is the outlook for UK inflation, and what does this mean for UK interest rates?
Well, yes, the good news is that inflation is finally falling. It's actually the lowest since March last year. But the bad news is that it's not falling as quickly as markets, as economists and the Bank of England had been expecting. But I suppose there are good reasons to think that inflation will continue falling and perhaps will start falling a little bit more quickly in the months ahead. So, for example, in the news, we've had news about the price cap on energy prices, and so energy prices will be coming down in July. Gas prices, natural gas prices, they've already fallen to levels that we saw 2 years ago, and half the level before the outbreak of war in Ukraine. And that's not just good news for people heating their homes and the like. Natural gas is very important in the production of fertilizer. And higher natural gas prices have meant higher fertilizer prices. And that's one of the main reasons why food prices have been going through the roof over the last year or so. So falling natural gas prices should feed into lower food inflation as well. On top of that, when we look at sort of the prices of goods leaving the factory gate, as it were, so not in the shops, but leaving the factory gate, and even those prices of the inputs that factories are using to produce goods, those prices essentially are unchanged over the last year. So there's evidence of that certainly price inflation is cooling further down the supply chain, and that ought to start feeding its way into what people see in the shops in the coming months. So that's good news. But I suppose the bad news is that whilst inflation has cooled, particularly service sector inflation, and the service sector is very important, of course, in terms of economy and in terms of the kinds of things that people buy. It's not just goods like DVD players and food and the like. Household services are very, very important. Service sector inflation is a very stubborn 7%. And underlying inflation, what economists call core inflation, which ignores the impact of food and energy prices, that's still just below 7%, and it is actually higher than it has been during the recent episode of rising inflation. So from that perspective, it looks as if inflation definitely isn't under control, even though there are good reasons to believe that the headline rate will fall markedly over the remainder of this year. And it's the fact that underlying inflation, so ignoring energy and food prices, is still so stubbornly high that has forced markets to reassess the outlook for UK interest rates. So before we had the latest inflation number a couple of weeks ago, the market had been pricing UK interest rates, which are now 4.5%, maybe to rise to 4.75%, so one further rise. But because underlying inflation has picked up and still remains so stubbornly high, the markets now think that there's a reasonable chance that the bank will have to raise rates perhaps three more times now, so to over 5%. Now, the good news is that there is going to be another release of inflation data before the Bank of England meets again. So there is the possibility that we start to see inflation fall more markedly, as indeed it has been in the Eurozone, for example. And that might be enough to persuade the Bank of England that it doesn't need to raise rates too much more aggressively. So we really are in a sort of a situation where markets and policymakers are in a wait and see mode. They're very much dependent on what the data suggest. And as I said, there's reasonable grounds to think that inflation will be falling markedly over the course of the year. It's just a matter of how quickly it does so. And certainly when we look at economic activity in the UK, we would think that that should be sufficiently depressed to bring down inflation. And if we look at the US or the Eurozone, where inflation has been falling more noticeably and a little bit earlier, that would give us reasons for hope as well. And particularly, as I said, with natural gas prices half of where they were before the the outbreak of the Ukrainian war, that certainly gives reasonable grounds for optimism. But it really is a case that we're in wait and see mode. And if the inflation number that comes out in the middle of June is disappoints again, just like the number that came out in the middle of May, then that pretty much does seal probably another couple of rate rises, which, given that house prices are falling already and have been falling for 6 months or so, that's obviously not good news for borrowers, but obviously it's good news for savers.
Excellent, thank you. So if we turn to the US now, after its last meeting to set interest rates, the US Federal Reserve hinted that it might pause and leave rates unchanged. Do you think the Federal Reserve will indeed take a breather? And does this mean that US interest rates have now peaked and the next change will be a cut?
Well, certainly the Fed, with its last rise, basically had raised rates 10 times in a row now, and that by itself is perhaps a good reason to take stock and take a pause and reassess the economic climate. Certainly, when we look at inflation in the US, it's a better story than the UK, for example. So US headline inflation is the lowest it has been in 2 years. Underlying inflation, so core inflation, so ignoring the impact of energy and food prices, that is basically back to levels that we saw at the end of 2021. So the inflation picture is certainly more positive than either the Eurozone or the UK. US inflation is below 5% at least. But a bit like the UK, and indeed like the Eurozone as well, underlying inflation, core inflation, is stubbornly high. So that's about 5.5%. And whilst it's been getting lower over the last 18 months or so, it's been doing so very, very slowly. And so, to some extent, not as bad as the UK, inflation isn't receding as quickly as policymakers would want, especially when you consider that they've been raising interest rates for the best part of a year and a half. At the same time, obviously, we've had the turmoil in the banking sector, and that's made itself felt in terms of banks raising their lending standards, their credit standards, making it harder to get a loan. And the Federal Reserve acknowledged that it thinks that it is going to add to the I suppose the way the monetary policy is going to constrain growth on over and above what it was achieving through raising interest rates alone. So that was one of the reasons why the Federal Reserve, after its last meeting, indicated that yes, it was thinking about taking a pause in June, but since then we've had sort of more data that the US economy, whilst inflation is coming down but slowly, more evidence that, well, the economy is still running too hot, and particularly consumer spending. So whilst the manufacturing sector in the US looks as if it's in recession, the housing market is very soft, consumer spending is still very, very strong, especially on services. And one of the reasons there is that the labour market is still in rude health. So wage inflation is still quite high, and the labour force and the labour market is still growing. And too much really, too strong for the Federal Reserve to be comfortable that inflation is going to come down as it would want. And it's always harder to bring down inflation from, let's say, 5 to 2%, which is what the Federal Reserve has to do, than it is to bring down inflation from 10 to 5%. And policymakers are acutely aware of that. But that said, given that we know that banks are tightening credit standards and we're a little bit uncertain about just how much of an impact that could have in the US, it seems reasonable to think that, given what they've said, the Federal Reserve will indeed take a breather in June and take stock of the situation. And again, like the UK, they have the benefit of being able to see, get some more data on inflation and activity before their next meeting. So they'll have a little bit more knowledge on how the economy is cooling and if inflation is cooling as it would want. I suppose one thing I highlight, though, that whilst maybe the Federal Reserve will take a breather, and that could well indeed be the last hike of the cycle, as it were, markets think that by the end of the year, the Federal Reserve will be cutting interest rates. And that's really where we would beg to differ. The Federal Reserve have said time and time again that markets and consumers should get used to the idea of interest rates being higher for longer. Given that it's been so slow to bring down inflation, the Federal Reserve wants to make sure that inflation really has put out the fire of inflation, if you want, and inflation isn't suddenly going to burst into flames again. So it's going to be keeping rates higher for longer. It's not going to be cutting them aggressively, even if, as they themselves expect and as markets expect, that there will be a very mild US recession. They want to make sure inflation is well and truly back in the bag. And so that's where we would differ on the sort of the market outlook. So I'm not expecting a cut anytime soon, but certainly there's good reasons to believe that certainly the Federal Reserve will be taking a pause. And if activity does slow noticeably, as we in the markets expect, we certainly would think that that would be sufficient to start bringing down inflation now.
Thank you. So over the past month or so, fears of a banking crisis seems to have faded and markets have settled down a little. How are we positioning our portfolios as we head into the summer?
Well, it's certainly true that the markets are a little bit less jittery than they were perhaps earlier in the spring. At the same time, though, that perhaps under the surface, markets aren't as confident as perhaps they appear. So if you look at the performance of the US stock market, it's certainly been rebounded quite strongly since the banking turmoil that was sparked by the collapse of SVB Bank. But interestingly, it's only a number of well-known stocks, particularly technology stocks, that have been driving this, and particularly with the sort of boom in AI and stocks like Nvidia, which is now the world's most expensive or most valuable, whichever way you look at it, most valuable chip stock. They've been doing very well, but banks, for example, haven't really rebounded since the sort of the March jitters and the sort of nervousness in markets. And so it's sort of a tale of two stock markets in a way, that some of the beneficiaries from AI have been doing very, very well, whilst the rest of the market hasn't been doing quite so well. So certainly fears of a sort of a broader credit crunch have faded away, and that's been good news for the market. But certainly the market isn't quite as strong as it appears if you just look at the headline numbers. Now, there has been some good news. So we are seeing the resolution of this ongoing debate about whether the US government can raise its debt ceiling, so whether it can actually issue more public debt. That now is becoming less of a drag on the markets. And to be fair, the markets assumed that there would be a deal anyway. So that's good news. So a little bit less uncertainty over the economic outlook, over the outlook for the US government, is better news for markets. But at the same time, certainly the summer is not usually a great time for equity markets. It's usually a pretty good time for bond markets, and we'd be sort of a little bit on the cautious side in our positioning at the moment. So fairly neutral on equities, but perhaps a little bit cautious about taking too much risk there, particularly in the US, where we think valuations are more stretched than other markets. Where we're a little bit more positive is on the outlook for bonds. So we do think that we are coming to the end of the interest rate cycle. And whilst we would differ with the markets on just how quickly interest rates will start coming down, we still think that bond yields at these levels are at least range bound at the very worst. So they're going to track sideways. And if activity does slow noticeably in the US more than expected, then we would expect bonds to do very well in that environment. And so we are overweight in bonds. We're overweight in high grade credit. So we do think that at these yield levels, especially after the performance of the last 18 months, which have been a horrible time for bond investors, the bonds are pretty attractive and should be for the foreseeable future. So a little bit more positive on the outlook for bonds and a little bit cautious on the outlook for equities at the moment.
Thank you, Haydn, for such a detailed update. So thank you for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require guidance or advice, we would recommend you contact your professional financial advisor. Thank you once again for listening to our podcast, and we look forward to speaking to you again soon.